Hello everybody. Professionally, I will explain the material that I have summaries about cost accounting, namely direct cost and indirect cost, analyst reports on investment in the stock market. My name is Rizky Alviani from the Faculty of Business Economy, majoring in accounting Mercubuana University. Explanation of cost accounting as well as with case related to cost accounting, direct cost and indirect cost. What is meant by costing accounting? Cost accounting is the activity of record, classifying, summarizing, and presenting reports related to costs and financing transactions used in the production or distribution process of a company product. What are direct costs? Direct costs are costs that are directly related to program coordinator and French channeliers, bus rental for students under any grant program that can be dedicated directly to your program. What are indirect costs? What costs that are difficult to link and assign directly to the unit of production and are accurately tracked to cost object. Example of indirect costs. The first, utilities operation and maintenance costs, janitorial security etc. Second, general administrative expense of accounting include payroll, purchasing, auditing etc. Third, depreciation and usage allowance, building and equipment repairs. Comparison of indirect and indirect costs. Basic for comparison, direct costs and indirect costs. Meaning, direct costs there are the costs that can be easily identified as per the cost object, and indirect costs that are the costs that aren't easy to identify as per the cost object. Expanded on, direct cost particular cost object and indirect cost particular cost object can be identified as direct cost. It can also be called as variable cost, and indirect cost it can also be called as fixed cost. Placed in the cost sheet, direct cost it is computed at the beginning of the cost sheet, and indirect cost it is ascertained after computing the direct cost. Aggregate in the cost sheet, direct cost, and aggregate of direct cost in the cost sheet is called prime cost. And indirect cost, the aggregate of indirect cost in the cost sheet is called offer cost. The case of direct cost to the company, for example, a company that wants to design a new building needs to hire a project manager to oversee the construction. Project manager salaries are included in direct cost. Example of direct cost for drivers and common and which include in the production of concert. The cost of indirect costs to the firm. In the production department, there are many employees who exist in the department, such as production staff, foreman, and will and head of production. When the production department carries out the chart production process, the salary cost of these employees must be charged as production costs. However, salaries for the foreman and the head of the production department are categorized as indirect costs. Why is that? Because the cost of salary for the foreman and the head of the production department cannot be defined exactly how much value should be allocated to each unit of the chart produced. Another case with the cost of production staff salaries. Let's say the every day the production staff is paid 1,000 uh, 100,000, and today the production staff produced 10 shares. Then the cost of production staff salary allocated to each unit charge can be calculated by dividing staff salary per day and production result in order to obtain a value of $10,000, which must be charged to each product unit. The role of accounts and the age of globalization. Account is a profession that is actively involved in the global economy and borders economy. How does an accountant respond to the future? The first invest in digital skill development. The second, education based on international certification and digital skill. Third, curriculum and learning based on human digital skills. For implementing new technology prototypes will learn by doing. 5. Responsive to change in the industry, business, and technological development. Liquidity ratio. Liquidity ratio refers to a company's ability to meet its short-term liabilities. Liquidity ability is measured by looking at the company's current asset against its current debt. To frequently use liquidity ratio are the current ratio and the quick ratio. Current ratio show a company ability to meet its short-term liability using current asset, whereas the quick ratio shows the company ability to meet short-term obligation without include surplus as in the current ratio, because inventory is considered to require a process to become cash. Okay, thank you for everybody.